Kaushal Bengani, DGM Investor Relations and Finance is joining us. Kaushal, afternoon. Thank you so much for your time. There are a lot of triggers in your company and it is one of the favorite stocks of the market. So let me start with something which is exciting the street a lot, and that is your company has turned debt free and there's been a lot of voluntary repayment of debt. What are the thinking at the management level? So what's the harm in running bit of some debt on the books?
Thank you. We have done really well over the past year and a half. We have turned around the company. The reason for making prepayment debt was we had good visibility of cash coming in and the current levels that we have. So in the past 8 months, we have prepaid debt of 600 crores, and our total debt was at gross level was 600 crores. Currently, we are sitting on cash of close to 800 crores, and we are quite comfortable at having the debt-free position. And it is something which has been the legacy of this company, that it has always tried to have minimum interest cost and maintain a debt-free position. So, if you look at our history, we have been renowned in the list of companies which had low debt and were debt-free most of the times.
Your company has been one of the big beneficiaries of the point that when a few companies which are American Petroleum Institute certified pipes, seamless
Yes.
pipes, right? And you have almost 20% market share now. And there is one section of the market which believes that because of the Ukraine war, a lot of such companies out of that region couldn't operate at full levels, and incremental orders came our way here. Things have things changed a lot, or do you think it was only a one-off kind of a extra benefit, or you think it is structural now?
There are 2 points I would like to make. Firstly, we have a market share of 55% in the seamless pipe segment. And we were, in fact, one of the beneficiaries of the uh, macroeconomic changes which took place, because API certification is a certification which is very difficult to obtain. And we are one of the few companies who have managed to successfully obtain this certification for almost all of our products in all of our facilities. And we had a strong order book for quite some time in the export segment. The only change that we saw on account of the macroeconomic development was our margins increased positively. And going forward, we expect margins to sustain at an elevated level, which we have displayed in the past financial year. Currently, as I see, you pulled up the order book. Our order book comprises 55% of orders from Oil India and ONGC. Exports have taken a slight slowdown. However, that has not impacted us because our domestic order book has improved substantially. The point which I would like to make regarding the structural nature which you pointed out was in the December quarter, we had an order book of close to 1700, 1800 crores. And towards the conclusion of the March quarter, we have an order book in excess of 2000 crores. Our sales during that period has also improved by 22%, which means that the market is extremely buoyant and we are poised for another good financial year.
Right, sir. This is Vinny joining in the conversation as well. And what I want to know and touch upon is the order book that you are highlighting. You said from December quarter it was around 1700. By the end of March quarter, it was 2000 crores.
Yes.
FY24. I want to know that. What is that number that we should be expecting? How is that looking like for the company, both in terms of the export orders coming in as well?
The order book that we have is for a period of 4 months approximately. Theoretically speaking, we can take orders going into 2024 as well. But the policy that we have internally within our organization is every time we get an order, we book raw material against that order. So the larger the order book we'll have, the larger the inventory there will be. The orders are being replenished on a daily basis, and we expect to maintain a strong order book going forward. We see no headwinds of any kind, and we are quite confident that we perform really well.
In terms of the margin point that you highlighted, that you're expecting margins also to do better now given the current scenario.
Yes.
Just looking at Q4 margins, they were at 19%. Over the last 3-4 quarters, when I compare the last year, it was in the range of that 17 to 19% is where you were maintaining it. So is that
Yes.
19% doable, or is it better than 19% is what we should expect in terms of margins for the company in FY24?
EBITDA margins would be good. If you look at last year, then last year our EBITDA margin was close to 14%. Now our EBITDA margin in the previous quarter was 19%. We expect margins to remain good going forward. And considering the buoyancy in the market, as I said earlier as well, we are expected to perform well.
Before we let you go, just a quick word on how visibility in terms of numbers, your top line
Yes.
and profitability growth numbers, if one would take a 2 to 3 year view, you think you'll clock 20% plus kind of growth? What's the visibility?
It would be difficult for me to quantify a number considering we have an order book of 4 months, and that is the working capital cycle that we operate upon. But considering macroeconomic factors, the way we are positioned, being a market leader, having 55% share, the way government of India is going forward with increasing oil and gas expenditure, we are set for a path of growth.
Okay, thank you so much, Kaushal, for joining in with us this afternoon, giving us an understanding on what we should be expecting from the company in terms of growth going forward as well.